Are stocks safe for retirement? Isn't that the $1,000,000 question? When you're my age or before my age, after 50 certainly, or you're ready to retire maybe a little bit earlier. In this video, I want to talk about are stocks safe for retirement and the things to look out for and kind of a big picture, because this is about really awareness more than anything else. It's about being aware of how stocks move, and that will affect how safe stock investments are for retirement. Hi, I'm Camille Gaines, and I talk here and write about investing and money talk. I'm not a financial advisor. I write about it over at my blog, retirecertain.com. I'm just a money and investing nerd, and here I get to talk about it, where it's a little bit awkward sometimes at a party or something if you start talking about the stock market or money. So in this video, I want to share with you something that's super important, and I drew it on my board because I got inspired to just really share this visually with you. So what I want to show you is an awareness of market cycles. So what scares me is when I hear people say that are like my age or a little younger, I'm invested in really safe stocks. And there's the safety factor about stocks, and I've written a whole blog about this at Retire Certain. There's the safety factor about stocks, but there's also the awareness of the stock market cycles, because most stocks move with the market as a whole. That means when the stock market crashes, the popular word, or really it's a bear market, when it really drops, it takes most stocks down with it. It's rare to find stocks that don't go down in a bear market. So it's not so much about being in conservative stocks as it is about having an that's important. That's important. I'll say that before I say more. But it's also the second really important thing is having this awareness of the overall market cycles. And this isn't about day trading or market timing. This is about long-term cycles, as you'll see. So having this awareness can help you make decisions to lower your risk if you choose when you are headed into retirement, so that you have less risk from your stock investments. So let me say that I've been investing since I was in my early 20s, which was, a while back, right, as you can see. So in the 1990s, you probably have heard this, or you may remember this. Stocks were just, it was a strong, what we call bull market. The market was really strong. It was going up, and everybody loved stocks, and I'll talk more about that in another video. But everybody loved stocks. They were going up. And I remember at the end of the 1990s decade, a few really savvy experts were saying on, television, the media, investors can't plan for the next decade to be like the 1990s decade was. Boy, were they ever right. Because the next decade, and here's 2000 here, if you can't see this, the next decade, we had two nasty bear markets that really hurt people that were our age that had money invested in stocks. During that next decade, it's referred to as the lost decade sometimes. So during that lost decade, which started about here at my purple arrow in early 2000, we had a couple of bear markets, and in that decade, the first one was the early 2000s, and the market went down, and then the market went back up, and then we had that nasty bear market that began in 2007, late 2007. And so after that, though, here we are at 2009. Look what's happened since then. The market's gone completely and wonderfully back up for stock market investors. What happens is that people start thinking, oh gosh, the market returns 10%. That's what I can plan on in my retirement planning. I'll put that in my calculator. And that's just, it's not always the case, because here's what's scary. And here's the awareness is in this decade from 2000 to 2009, the stock market actually, and this is the S&P 500 index, as you have probably know about, and that it represents the broad stock market in the U.S., large companies, it went down 2.72%. Now, if you factor in, well, yeah, but it was paying dividends. Okay, well, dividends are low, right, on the S&P 500 index. I've done another video, several on that. And so if you factor in dividends, it was down about 1%. But that was the whole decade, right? And so that's that can be a real problem. What if you were headed into retirement right here and you had put into the retirement planning calculator, well, the market's been doing, about 10%, and, I've got some money in bonds, so I'll plan on getting about 7% or 8%. Like, I remember I was thinking, well, I think we can kind of plan on 8%, for our more traditional investments. We do other alternative investments, but this is about just stocks, because this is what we did for so long. And so having an awareness that people were expecting about 8% because that's what it had done recently. There's this thing called recency bias, which makes us think that what's happened lately is going to happen again. And that's in behavioral finance. It's a very popular term, kind of a buzzword now. And so a lot of people planned on that. Now, the reason this is so important, and I had to jump up and draw this on my whiteboard, is that, what do we plan for going forward? Nobody knows, right? And all of the gurus and experts have been saying for years, this bull market we're in is going to slow down, and, we're going to enter another bear market. We're going to have a recession. And that's the thing that this is usually related to, is the economy. And so I've done another video on that. I won't go into that in this video. What I want to do with this video, the purpose is just to bring an awareness that the safety around stocks and whether stocks are safe for retirement is not just about the stocks you've chosen or the funds you've chosen. It's about the overall market and having an awareness of that as you head into retirement or you plan for retirement. What do you do if you're worried about it? There's several things you can do. People that are diversified into U.S. Treasury bonds, that's kind of the standard method, because U.S. Treasury bonds tend to go up when the stock market in the U.S. goes down. You can increase cash. I've written an article about, all of this, as I love to write about this because it's so important. Been there, done that. And I feel a drive and a passion to write about this and share about what I learned from my own experience. And then the other thing is alternative income streams. That's what we decided to do after the two bear markets of the 2000s. And that's many other videos that I won't get into here. But this is what I really wanted to share with you, is having an awareness that, this time period, this lost decade was down almost 3% if we don't include dividends. And if a retiree had been living on dividends, then they wouldn't have had that dividend to compound and be included here. So 3% is very reasonable for someone in retirement. But here's the other thing, the last thing I want to mention in this video, super important, and that is that this has gone up since we had this bottom here in March of 2009. The stock market's gone up 300%. And so you can't say, I'm not going to invest in stocks, because, you can miss these big runs where you get these big returns in these bull markets. But what you can say is, before I invest in stocks, I'm going to see where we are in the market. I'm going to see what's going on. Hindsight is 20/20, right? But you can also look and see where we are right now relative to what's happened in the past. And then when you do that, you can invest based on data, on facts, on history, on math, rather than letting emotions take charge of your investment decisions. That's what I wanted to share with you in this video. If you liked it, please click the thumbs up button, or the like underneath here. I think it's a thumbs up under my video. Subscribe to my channel if you like this and you don't want to miss my videos. And come see me at retirecertain.com. I've written much more about this, and I'll do more videos, so be sure to check back at my channel here. Thank you.